the names that, we listed in our note this morning are all kind of core names. And because we don't do a lot of or invoke a lot of turnover in our portfolios that we manage for a great wealth management system in both the United States and Canada, our clients are already invested in those names. And if you take a look at where there's been blood in the streets, not like a Warner Brothers Discovery today, because obviously there's some operational issues there, but names like Morgan Stanley that were down, or the Apple pullback, or even Lululemon, when there's
right.
Strong fundamentals underneath that, Tom, we want to own those names longer term. We've had an opportunity this week to kind of rebalance portfolios.
And what's important here, folks, is the adults look at the Bloomberg and they use fundamental technical and economic analysis. Paul, the weekly chart, not the daily gyrations, smooth it out a little, Paul. The weekly chart, take it logarithmic, Standard & Poor's 500, and Belski has this tattooed to his brain. We are perfectly back to the long-term bull market moving average using the exponential moving averages I use. We haven't even broken long-term support, and we're all going to cash.
People were freaking out in Monday morning, Brian. There was a sense of panic in the market here. I mean, did you sense that? And what does that tell you about maybe how investors are thinking about this market?
We did, Paul, and it's still the old notion, attention spans of gnats. And oh, by the way, it's gotten worse. We seem to have forgotten that August is usually a very bad month, and we've had it in 2022 and 2023. But if you go back to the 90s, it was 5 straight years where August were negative. And it's really, especially this year, Paul, I think too, because a lot of people are on vacation. And the adults are away, quote unquote, and I think that's what's caused. Even this morning, with the goofy move in the treasuries off of an employment report, which we are guessing, by the way, that the employment report is going to be restated and not as bad next month. So I think people are way too macro oriented. We've said it on your network before. We think this is like taking candy from a baby, meaning you want to be an investor, you want to buy good companies, you want to buy the dip. And it's the old notion of the Warren Buffett rule, is that you buy when there's blood in the streets and there's lots of emotion. So we're actually excited about what's going on because this is actually quite normal.
Quite normal. A lot of folks, Brian, has been saying, in a normal bull market, you do need to see some pullbacks here, 5, 10, 15, 20%. So maybe that's kind of what we saw a little bit here. How about some of these big tech stocks that historically have moved this market higher? They have been weak. There's been that rotation trade. What do you do with some of those big tech stocks here these days?
Well, we really continue to believe that from a thematic basis, those big tech stocks, we call them the Super 7, are really your consumer staple stocks now. And you keep core positions there, much like Warren Buffett did, by the way. He just sold a little Apple. He was way overweighted, and he's owned the stock for 20 plus years. So I think that's been there's been way too much negativity surrounding that. But then you start buying these other tech stocks like Palantir and Oracle and AMD and Qualcomm and Broadcom. But I think what people are missing is the broadening out effect of owning a little bit of everything. It means small mid-cap stocks. It means value stocks. It means financials. It means playing themes and being more fundamental.